Good morning, and thanks for joining us today. You have logged on to KBRA's webinar titled Understanding KBRA's Methodology for Insurance Financial Strength Ratings. Okay, let's begin. Most of the commentary today will be handled by myself, Tina Bucco, Senior Director of Business Development, and Andrew Edelsberg, Managing Director, Insurance Ratings. Luckily, the entire insurance team is in the room with us today, and they will share various comments as we go along through the presentation. The agenda. Since I do believe some of our registrants are new-ish to KBRA, I will start with a very brief overview of the company and the insurance vertical. Then we'll move on to the heart of the webinar, which is our insurance financial strength rating methodology. From there, we'll discuss how we monitor a rating. I'll provide some closing summary comments, and we'll answer any questions that may have come in. Actually, now's a good time to remind you to please feel free to submit questions as we go along. Some of your questions may be covered in the presentation. Those that are not will be addressed at the end, or if we run short of time, I'll be sure to follow up with an email to the entire group to ensure we cover everything. Okay, let's get started. So, who is KBRA? Well, we were founded by a gentleman by the name of Jules Kroll and another by the name of Jim Nadler in 2010. Both gentlemen remain in leadership roles at KBRA, with Jules Kroll being our chairman and Jim Nadler being president and CEO. We were born out of the financial crisis and established with the sole mission to restore trust in credit ratings by establishing new standards for assessing risk and setting new standards of excellence and integrity by offering, ready, timely, transparent, and accurate credit analysis. Okay, let's move on to the KBRA overview. So this slide provides a bit of color to our depth and breadth as a full service rating agency. So the top left of this slide shows the number of ratings issued, dollar amount of rated issuance, number of methodologies, and research pieces. We now have almost 300 employees with offices in New York, which is our headquarters, Maryland, Pennsylvania, and our newest office in Dublin, Ireland. You'll see we are a registered NRSRO by the SEC. We're a credit rating provider by the NAIC and a CRA with ESMA. From our roots in structured finance to our far-reaching coverage in public finance, project finance, corporates, financial guarantee, and financial institutions, which, by the way, includes our two newest verticals, banking, which started just about 4 years ago and currently boasts well over 100 public ratings, and of course, insurance. Nice segue into insurance overview. Here we go. All right, so as I mentioned, you'll see here just a reiteration of what I just mentioned. Regarding the SEC registered NRSRO, we are one of 6 NRSROs authorized by the SEC to assign credit ratings to all 5 classes of securities, including insurance companies. Our ratings are relied upon for investment analysis by many U.S. insurers. We published and released our methodology for insurance in April 2016, and our first IFSR rating was published that October. Now, in this year, since then, in that full year, we now have 20 public IFSRs with a robust pipeline. 8 of our public ratings are property, 8 are life, and 4 are financial guarantors. Also, we most recently released for comment our proposed captive rating methodology, focusing on alternative risk, obviously captive. So here's the team. You've already heard me mention Andrew. You saw his picture earlier. We also have in the room today Fred DeLeon, Carol Pierce, and Patrick Kerboy. They are all members of Andrew's analytic team. Their experience comes from lengthy careers with various rating agencies, brokers, and reinsurers, with progressive experience from analyst to officer to committee co-chair, with expertise in property casualty, life, health, and alternative risk, including reinsurance, captives, risk retention groups, and the like. Because of our analytic depth and breadth, the team has the ability to draw on internal resources of a much broader financial institutional analytic group, consisting of over 50 senior level executives with decades of combined rating experience. They also benefit from extensive experience in the financial markets, including lending, investment banking, monoline bond insurance, surveillance, workout, and rating agencies. I think what is most important is that our analysts collaborate across asset classes to approach all complex credits. And of course, there's our business development team in insurance, which is handled by Stead Dowd and myself. So let's talk about our rating services briefly. We have published credit ratings, obviously. Those are monitored ratings. They're public, monitored. They appear on our website. A press release is issued, and they can be shared with unlimited number of third parties. We also have unpublished credit ratings. Those are provided only to the issuer, and they are monitored. Rating reports do not appear on the website. A press release is not issued, and the rating letter and report may only be shared with a very limited number of third parties. Not listed up here is the indicative rating service, which is always unpublished, and that is for hypothetical scenarios or startup companies and has very limited sharing. All right, let's get to the heart of the webinar. Andrew, are you ready?
Absolutely. Thanks, Tina. So our global rating methodology describes the factors that KBRA considers when assessing the financial strength of insurance operating companies and assigning debt ratings to insurance holding companies and operating companies. And under this methodology, we will assign ratings to life health, property casualty, title, fraternals, and reinsurers utilizing KBRA's Insurance Financial Strength Rating Scale. The IFSR reflects the likelihood of an insurer meeting its senior-most financial obligations, which are its policyholders. And this scale will also be used to assign ratings to captive insurers. Now, issuer ratings for insurance holding companies, which are based on the IFSR, as well as the issue ratings on holding company long-term debt obligations, will utilize KBRA's long-term credit rating scale. And we will also assign ratings to short-term debt obligations, and these are based off of KBRA's short-term credit rating scale.
Excellent. Before we move on, you'll notice that there is a picture of another methodology up there, which is the Global Captive Insurance Rating Methodology. Carol, maybe would you like to briefly address the status of that methodology for us?
Sure, Tina. The methodology was released for comment at the end of July, and the comment period ended on the 18th of August. The final version that you see on this slide was released on August 30th. And while this version incorporates some clarification as a result of feedback we received during the public comment period, there were no substantive changes made to the methodology framework. And the proposed watermark that you see on the methodology will be removed upon formal KBRA board approval. And right now we're anticipating that this approval will happen in November. At that point, the methodology will be posted to the KBRA's website, and in the interim, you should contact Tina or Stead if you would like a copy.
Great, thanks, Carol. One last note, once that final methodology is out, we will hold a separate event just specific for the captive methodology. Okay, back to you, Andrew.
All right, thanks. So that takes us to the next slide, which shows a side-by-side comparison of KBRA's IFSR scale and those of the other agencies. And as you can see, ours is consistent with the capital market scale, or the AAA scale, with which the investment community is most familiar. Now, before I get into this graphic, I just have some high-level thoughts about the process. The KBRA's ratings are intended to be forward-looking and therefore are likely to take into account projections and estimates. The IFSR process is intended to capture the financial and operating risk to the policyholders of an insurer, and ultimately to indicate the likelihood that the insurance company will meet its policyholder obligations over the long term. Our process is designed to be the ideal blend of quantitative and qualitative analytics. And we truly believe that we have developed a methodology that's both comprehensive yet flexible enough to evolve with companies and markets over time. So let's dive into the specifics. On this slide, you'll see that the KBRA IFSR is based on the sequential incorporation of 4 steps. Step 1 is our quantitatively based Insurer Quantitative Assessment, or IQA. This is expressed in lowercase letters using KBRA's long-term credit scale. After the application of stress testing, the IQA is converted into a Preliminary Credit Assessment, or PCA. And for step 2, we overlay a thorough qualitatively based evaluation. This encompasses factors that may have financial underpinnings, but contain some subjectivity. So these include major categories of balance sheet management, operating fundamentals, and company profile and risk management. Step 3 is external considerations, and this step could result in either potential credit support from a parent organization or an affiliated group, or a negative impact from perceived risks outside the insurance operations. And the final stage is step 4, a potential rating constraint due to currency transfer risk. So to reinforce what I said before, our analysis of insurers is really a true combination of quantitative and qualitative elements. And now I'll go into detail on each of these 4 steps. So the first step, as I said, is the Insurer Quantitative Assessment, or the IQA. The IQA pretty much sets the foundation for the overall rating evaluation. And our approach uses a series of financial metrics, which are generally statutory based. However, we also consider GAAP and IFRS if applicable.
So maybe before you move on, can you, Andrew, maybe just give some examples of the ratios that you look at and the ones that are most important?
Sure. For property casualty companies, we look at net leverage and ceded reinsurance leverage, the combined ratio, operating ratio, a return on capital, as well as the NAIC risk-based capital ratio, or RBC. For life and annuity companies, we focus on capital and surplus to total liabilities, high-risk assets to capital and surplus, the percentage of interest-sensitive reserves, net yield, one-year operating return on capital, as well as the NAIC RBC. We felt that these were some of the ratios and leading indicators that represent the principal drivers of the financial strength of insurers. Additionally, for organizations with holding companies on a GAAP basis, we consider such things as intangibles to equity, financial leverage, interest coverage, double leverage, and off-balance sheet items as well. It's important to note that the IQA is intended to be an issuer-level assessment representing a first-cut view of the standalone risk of an insurer. So anything outside the insurance company is considered later in the process. So to facilitate the analysis, affiliated companies within an organization may be consolidated. For example, many P&C organizations have pooling agreements, and these will necessitate group-level evaluation. And we compare the ratios I mentioned to those of similarly sized peers, competitors, as well as industry averages. And based on the distribution of results for each ratio, the IQA score is calculated with each ratio getting an equal weighting.
Great. Andrew, so you mentioned how you consider NAIC RBC as one of the key ratios. Maybe if you could drill down a little bit on how we're able to assess risk without having an internal capital model.
Sure. Well, a key part of that assessment is stress testing. We apply a series of stress tests to incorporate the potential forward-looking risk scenarios that are typically not factored into the quantitative analytics. So these tests provide a powerful tool to determine the sensitivity of a company's current financial position and its ability to maintain its long-term financial strength under duress. But generally, these are medium to severe economic environments where we analyze the impact on an insurer's capital and earnings. These may include the impact of regulatory, industry, or company-specific events. We may rely on public information or incorporate unique risks to estimate forward-looking scenarios. For PC companies with natural catastrophe exposure, we'll typically stress test capital and earnings for severe windstorms and earthquakes. We also examine the insurer's own capital models and their array of stress scenarios based on their top risks. And ultimately, we expect our assigned ratings to withstand moderate levels of stress over the near to medium term.
That's great. Thank you. I want to address a question that came in quickly. Someone asked, they wanted to know if we were focusing just on life or PC as well. And so I just want to make sure we get that out there right up front. We rate both companies, property casualty and life. Okay, so let's move on. Thanks for that, Andrew. I do want to mention, so stress testing clearly is paramount. Maybe you or one of the team in the room can give a short example of how we apply stress testing to one of the companies that we currently rate.
Okay, Fred?
Yeah, sure, Andrew. Well, in light of the recent severe hurricane activity, the example I'll use involves natural catastrophe stress testing. So one of our rated companies is a property writer with a geographic concentration around New York City and Long Island. For this company, we employed several catastrophe stress tests. These stress tests were an attempt to quantify the impact of various scenarios on the company's capitalization, earnings, and projections. So with this company, first, we looked at how effectively their reinsurance program worked with their PML, or probable maximum loss analysis, at the 100-year return period and higher return periods. We also looked at how their reinsurance worked with multiple severe events. Lastly, we performed some scenario testings. So in this case, the company had high gross losses from Superstorm Sandy in 2012. However, the net losses were significantly reduced through prudent implementation of high deductibles and comprehensive catastrophe reinsurance. We also looked at the impact of Sandy today, given the company's exposure growth. In fact, although exposure has increased, a repeat of Sandy would result in lower net losses today. Further, if Sandy were to impact the company's most concentrated area, the losses would also have been manageable.
That's great. Thank you, Fred.
So the application of stress testing may lead to an adjustment to the IQA. And once the stress tests are factored in, we reach a preliminary credit assessment, or PCA. It is at this point where we overlay our qualitative evaluation. So our qualitative evaluation focuses on three key rating determinants: balance sheet management, operating fundamentals, and company profile and risk management. And for the most part, the basis for our qualitative evaluation is the face-to-face meeting with the company's management team. It's important to note that we plan to visit every company we rate at their company headquarters. We prefer to meet not only the senior management team, but to have conversations with the heads of the business lines, actuaries, investment personnel, etc. Basically, do anything we can to gain a full understanding of the company's business model, operating strategy, risk culture, and overall appetite for risk. Each of the three rating determinants has 4 subdeterminants for a total of 12 categories that are evaluated. So for balance sheet management, we look at underwriting leverage, asset quality and investment risk, financial flexibility and access to capital, as well as liquidity and asset liability management. For operating fundamentals, the subdeterminants are current year profitability, consistency of profitability, earnings diversification, and exposure to event risk. And finally, company profile and risk management entails an evaluation of management expertise and the strategy, market position, distribution, and risk management. For each subdeterminant, the analytical team decides whether that particular factor has a favorable, neutral, or unfavorable impact on the credit profile of the insurer. Specifics as to what guides these evaluations are outlined in detail for each subdeterminant in the methodology document. But I thought I would quickly run through an example. So on the next slide, you'll see, as part of the operating fundamentals rating determinant, at the bottom of the chart, we have exposure to event risk subdeterminant. This factor can have a favorable impact on the insurer's credit profile if the exposure to sudden unexpected events is low. This likely would result in the assignment of a +1. In contrast, the evaluation may be unfavorable if there is elevated exposure. This can include geographic concentrations, country risk, high interest sensitive business, or if market risk has a major impact on the insurer's results. So if this subdeterminant is deemed to be unfavorable, then it will be scored a -1.
Okay, so that was great, thank you, but that was a lot of words. So how about can you give a real live example, or maybe one of the analysts in the room?
Sure. Patrick?
Of course. Exposure to event risk, the last row within the provided table on slide 14, if you're following along with the presentation deck, provides our qualitative descriptions across the subdeterminants. To restate loosely, event risk can be defined as an unforeseen event or an event with a remote possibility that will negatively affect the operations and financials of a company, taking into account a variety of company-specific factors. 2 specific examples that come to mind, the first being Nat Cat, and the second being adverse reserve development. The first involves, as previously highlighted by Fred, reviewing various scenarios of losses occurring from a natural catastrophe to a regional property underwriter. This carrier has approximately 80% of their business in personal lines, specifically homeowners, renters, and personal umbrella, with the balance being small commercial policies, all concentrated within 3 counties of one state. The event risk is driven by both a product and geographic concentration of totally insured values coupled with historical storm activity. Intertwined with the exposure and weather risk, and equally important, was developing an understanding of the reinsurance in place for both the first event along with potential additional events, weather events in this circumstance. An additional event scenario that was reviewed in one of our ratings was regards to adverse reserve development. This particular one for an expanding niche-focused specialty P&C insurer that has legacy operations, state-specific attritional claims, which were experiencing sizable reserve deficiencies, and the necessary corrections were materially impacting the calendar year operating results and deteriorating the company's capital position, offsetting the stronger performance of the core focus of the business, specialty, industry-focused, commercial package, and liability products. We are able to review the components of this book of business and couple that with management estimates and requirements for the renewal/non-renewal of portions of the book of business to fully understand its impact going forward, rather than assuming a straight line approach. With regards to life and annuity companies we have rated, we have looked at a wide variety of events, including spread compression and interest rate environment, product structures, and cash flows, to name a few. Bringing this together and paired alongside our internal analysis and integral to us forming our qualitative analysis is having met with the company and dialogued with them on their approach to various scenarios and overall management process. From there, we make a qualitative evaluation, as Andrew was stating, favorable, neutral, unfavorable, as a component of our credit opinion. I hope that provides sufficient color, but happy to dialogue further at the balance of the presentation.
That's great. Thank you, Patrick.
So to reinforce what we've covered so far, at KBRA, we place a material importance on performing deep dives and thorough reviews of the companies, our clients, that we rate. So we review the 12 subdeterminants as part of the iterative and interactive rating process. The individual subdeterminants carry equal weight within the adjustment score, but we do, as highlighted in the methodology, have the ability to adjust the determinant weights in certain circumstances to account for the unique business models or other particulars we deem appropriate. This subjective process cannot be thought as independent from the quantitative analysis, or PCA, but more an overarching analysis of the business and a key component of our credit opinion. In completing our analysis and corresponding to our rating methodology, we intend for our analysis to be forward-looking, inclusive of projections and estimates. And as an aside, this component plays an important role in reviewing startup or de novo operations. So the final two steps in the process are to incorporate the impact of external support and currency transfer risk. External considerations could potentially result in multiple notch adjustments of the ICA, either upward or downward, based on our view of the level of support that the parent provides. For upward movement, this could be in the form of a formal guarantee. For example, a guarantee of liabilities, net worth maintenance agreement, reinsurance contract, or simply based on implicit support. On the other hand, our review of the enterprise may cause the analytical team to determine that additional risks are present outside the insurance operations that may impact the ability to pay policyholder claims in the long term. For example, non-insurance operations that are deemed to be less creditworthy, or material off-balance sheet liabilities, or significant holding company intangibles. This consideration can cause the ICA to be adjusted downward.
So, okay, you know, I love these examples, right? So maybe, could you provide a situation where the impact of external considerations were relevant to the actual analysis?
Absolutely. So one of the companies that we rate is an annuity writer based in the southeast part of the United States. For this particular credit, the analytical team reviewed the financial statements of affiliates and considered the financial condition and resources of the parent holding company and its shareholders to determine the impact of these affiliates on the insurance company's overall risk profile and creditworthiness. The holding company was established with 3 capital providers, and they committed a considerable amount of capital to the partnership. These investors purchased and recapitalized the insurance company and also maintained significant funds for future use for investing in the business or potential future acquisitions. So we believe that the shareholders and board members of this company are clearly committed to positioning the insurance company and the overall organization for growth and success, and therefore we recognized some uplift in the standalone rating to the published rating.
Perfect. Thank you.
So since KBRA's credit ratings are intended to be globally comparable, we must incorporate foreign currency or transfer risk, which is another important source of credit risk. Transfer risk arises from the possibility that domestic borrowers in a country may be unable to raise the foreign currency necessary to meet their foreign currency obligations. So a variety of circumstances may introduce transfer risk, including government-imposed exchange controls or currency devaluations, unanticipated events such as sudden political or economic upheaval, or other external shocks. So to reflect this risk, KBRA's insurer and insurance holding company ratings may be constrained. It's important to note that after our insurance ratings methodology was issued, KBRA has added significant expertise in the sovereign area, and about 4 months ago, we issued our sovereign rating methodology. So we plan to incorporate this approach to assessing sovereign risk on organizations with operations outside the United States in the near term. So now that we've reviewed in detail all 4 stages of the process, I'll take you through a quick illustration. So this is the rating sequence example slide. So based on our review of key ratios, a US-based insurer's IQA is determined to be A-, which you can see in the first column. The impact of stress testing on the rating evaluation was deemed to be minimal in this case, hence the PCA is also A-. Using our qualitative scores across the 12 subdeterminants, the insurer's aggregate adjustment score was calculated to be 0.42. KBRA analysts used this score as a guide to adjust the PCA by 1 notch to A. This is the ICA before external considerations and the incorporation of any currency transfer risk. After applying the impact of external support, which in this case was determined to be 1 notch, the ICA was adjusted upward to A+. Given that the insurer has limited to no exposure to foreign currency, there is no penalty for currency transfer risk. Hence, the final insurer financial strength rating for this example is determined to be A+. The next section of the methodology covers debt issued by operating companies. Although this is not the most common insurance-related issuance in the capital markets, some insurance organizations do issue debt securities at the operating company level. These are typically mutuals that issue subordinated debt in the form of surplus notes. So KBRA employs a notching process to rate the debt issued by financial institutions. Notching generally reflects differences in expected recovery for distinct issues and may be driven by differing priority of claims in bankruptcy or receivership, liquidation, corporate hierarchy, or by legal and structural subordination in a capital structure. As you can see on this slide, the surplus notes issued by an insurance operating company would typically be notched 2 from the IFSR. The last section of the methodology describes our process for assigning ratings to insurance holding companies, or IHCs. KBRA's long-term debt ratings for IHCs and their obligations consider several credit factors. The starting point is the lead operating company's IFSR. Just a reminder that holding companies and debt issued by holding companies utilize ratings from our long-term credit rating scale, which is on this slide. If the organization is comprised of multiple key insurance operating companies, we'll calculate a weighted average or blended IFSR. And this is done because a holding company doesn't have its own operations and relies upon its subsidiaries to service its debt. So once the IFSR is determined, KBRA will apply the following 4 IHC-specific factors. The first is structural subordination. An IHC debt has a lower priority of claim compared to obligations at its subsidiaries. Second is regulatory restrictions. US-based insurance holding companies are regulated by the SEC, while insurance companies are regulated by the state of domicile. Third is financial flexibility, where we'll focus on specific holding company metrics, such as financial and operating leverage, double leverage, liquidity, and non-insurance business lines. And then similar to operating companies, for IHCs, we also consider external support. The result of this analysis is the issuer rating of the holding company. Then, securities issued or to be issued by the insurance holding company, we employ a similar notching process starting at the issuer rating, which is equal to the senior unsecured debt rating. The typical notching between an insurance operating company and a holding company is 3 levels. However, KBRA reserves the right to vary from this general guideline in certain situations. Securities issued by the holding company are analyzed individually and notched accordingly.
Great. Before you move on, maybe can you talk about a situation where you might tighten or widen the notching between an operating company and a holdco?
Sure. One of the organizations we rate has both insurance and non-insurance subsidiaries. The non-insurance subs provide consistent fee revenue and income with little to no underwriting risk. Additionally, the non-insurance subs have a high volume of recurring transactions, which has enhanced the organization's earnings. The group has reported steady and diversified earning streams and has produced strong fixed charge coverage. So, due to significant fee income and strong fixed charge coverage, we notched the holding company's issuer rating 2 rather than the typical 3 notches. In contrast, we might consider widening the notching in situations where the organization has a substantial amount of one class of debt outstanding, or if its holding company ratios are considerably higher than peers or industry benchmarks.
Okay, that's great. Thank you.
My last slide touches on our annual review process. On an ongoing basis, KBRA monitors outstanding ratings on insurers, surplus notes, insurance holding companies, and their debt obligations. We generally accomplish this through ongoing dialogue with insurance company management, as well as by monitoring market information, publicly released financials, and other disclosures in order to maintain current rating opinions. Ratings are reviewed and updated at least annually. However, KBRA reserves the right to bring a credit before rating committee if the analytical team believes there may potentially be a change in the financial condition of the company due to a significant event, announcement, or simply based on our review of the organization's most recent results.
Okay, so since we're good with time, maybe can you talk a little bit about rating committee?
Sure. So at KBRA, we have 2 primary committees, the rating committee and the credit policy committee. The rating committee is highly focused. It's convened to review, assign, or change a rating, while the purview of the credit policy committee is much broader. It includes all other matters pertaining to the procedures, the methodologies, criteria, models, and other infrastructure necessary to determine, disseminate, and monitor ratings. But you're probably more interested in the rating committee process,
yes,
so I'll focus on that.
Yep.
So the purpose of a rating committee is to provide a formal forum for active participation and the sharing of multiple points of view. The lead analyst that's responsible for the rating, in consultation with his or her manager, can convene a rating committee at any time. The lead analyst will provide a rating committee memo outlining the proposed rating or action and supporting information. He or she will present to the rating committee members, at which time a discussion will ensue, often a quite lively discussion, and will culminate in a vote of all eligible members. All committee members have sector expertise, prior rating agency experience, or both. And analysts and committee members also must complete methodology, credit policy, and compliance training and testing before gaining eligibility to present or vote. What else? How about to achieve a quorum?
Yes.
A rating committee must have at least 3 voting members, one of which must be a managing director or above. All committee members are checked for potential conflicts of interest before any work is started on the credit, and then again at the beginning of the rating committee meeting. And following the conclusion of the meeting, the company is contacted as soon as practicable. Typical timing of a rating committee from the date of the interactive management meeting is about 6 to 8 weeks.
Okay, so you mentioned 3. Does that mean committee is made up of 3, or is it 3, 7?
So typically that's the absolute minimum,
okay,
per our policy, but we haven't had a rating committee that's been less than 6 or 7 members.
Okay.
You know, we try to have more members than less because we're a new initiative. So to me, the more people we have involved, the more education we have of the people
Yeah.
in the group.
Yep, makes perfect sense. Okay, thank you. And then it also might be helpful to explain how a company submits their data and how often you want the data for the monitoring process, right? Do you want it quarterly? Can they submit it electronically? Like, what are our parameters?
So what we've done is we've set up a secured shared folder on our server, and that way the companies that we rate have access and basically can just drop the information in there.
Okay.
So we don't have a formal supplemental data collecting process. We basically just ask companies for what we need to analyze the company, and there may be some subsequent follow-up information after the meeting with the company, but it's usually what we've heard is they're reasonable requests. You know, we don't ask for a ton of data that we're not going to use in the process.
And I guess, right, that's the key anyway. So there always has to be that open communication. So that's key. When we need something, we know to ask, and they'll know how to deliver it.
Right, and it's definitely some historical information. We try to go 5 years back and get statutory information as well as GAAP if it's available, and then of course the forward-looking information, the business plans and projections are paramount to the
Right, and then once they're in that process and they're on the annual cycle, then you want quarterly information, public information. Yeah. Okay.
Exactly.
Okay. Great. Fair enough. Thanks, Andrew. Okay. So that concludes the formal part of the presentation. Next, I'm going to do some of our closing remarks, and then we'll get to the Q&A. We have some good questions that came in, so I'll make this brief. So first, let me thank everybody who submitted their questions. We'll get to them in just a minute, and let me just quickly summarize where we are so far. So we know that our approach is qualitative and quantitative. We do not have an internal proprietary capital model, which allows more thorough financial analysis. Ratings are based on a company's unique characteristics. The process is completely transparent and interactive. Our ratings are respected and relied upon by investors and the capital markets. We have no size bias, no legacy issues, or rating caps. By the way, we rate startups. I always feel like it's important to say that every chance we get. We have no seasoning requirements for those startups. Minimal supplemental rating information is required. We are very customer focused. As Andrew mentioned, I think earlier, the team will meet with the company at an agreed upon location. We will always provide stellar customer service. We do provide preliminary confidential feedback to companies. We have customized and comprehensive rating reports. They are not template driven. And incidentally, all research and reports are complimentary on our website. All right, let's get to the questions, because we do have some good ones that came in. So the first one is, can you give some specific examples of how you benchmark? Somebody want to field?
Tina, I'll field that.
Thanks, Patrick.
In benchmarking, we like to look at the overall and the cumulative P&C industry with respect to P&C companies, but we find it important to narrow down and develop a specific peer set. An exemplar of that is a recent Southeast coastal property personal lines underwriter, and we narrowed it down based upon a lot of different factors, including the TIV concentration, the product concentration, in addition to the business origination and how that company went about it against the peer set we developed. That peer set was of 14 very specific companies, and we were able to develop both the quantitative analysis of it, but also a qualitative across those various companies.
Excellent, great. Okay, another question that came in is, will you be publishing a separate, this is a good question. Will you be publishing a separate methodology for rating startup companies? So this is a good question, but maybe before somebody answers it, maybe we could define what KBRA considers a startup.
Okay. Well, I would say that a startup is a company that has not yet been established.
Right. So it doesn't have any established time frame. It's not 1 year old, it's not 2 years old. It's only a business plan. Right. Okay.
Exactly. No historical information.
Yeah. Perfect.
So KBRA determined that it wasn't necessary to have a methodology specifically dedicated to startups. For newly formed companies across all insurance markets, we'll use our global insurance methodology, as it was intended to include startup insurers. Since these entities don't have historical financial information, The analysis will be focused on the qualitative aspects of our process, emphasizing management's experience, its business plan, product and market environment, investment guidelines, risk management practices, distribution, technological platform, core competencies. So the typical information we would review would include a detailed business plan with projected financial statements for at least 5 years, initial capitalization amount and the capital structure, the use of reinsurance, the use of financial or operating leverage, detailed information on the sponsors or investors and our assessment of how committed they are, the target markets and the competitive environment of the company, key differentiators of the organization, pricing methodologies, underwriting practices,
Right.
Risk appetite statements, risk tolerances, and then if they have an outside investment manager who's managing the investments and the initial allocation plan.
Right. Okay. That's great. Thank you.
I mean, clearly that's not an exhaustive list.
Yeah.
I do want to note one thing before you get to the next question is that we do not have minimum capital levels to be eligible for a rating.
Good point.
So we will rely on our decades of experience rating insurance companies as to the risks of the underlying business to be issued and evaluate the associated reserves, capital, and financial flexibility of the new organization.
Right. Well, and I think that goes to the point that we spoke about earlier, that, you know, that's the benefit of not having an internal capital model. We get to really look at a company based on what they do in their business plan and their model. So yeah, I think that's perfect. Okay, another question that came in. What return period do you use for PMLs, and can you be more specific on the actual tests, in quotes? For example, differences for traditional companies versus MPLI writer versus a reinsurer. Anybody?
Yeah, sure, Tina. Just to emphasize again, stress tests and scenario tests are critical in a strong enterprise risk management program. So examples include, like we mentioned earlier, natural catastrophe stress tests. And I guess part of that question is what return periods we look at. So, you know, typically we look at, again, hurricanes, earthquakes, and convective storms, which is tornado and hailstorms. So for storms like that, we usually look at the 1 in 100, 1 in 250, and 1 in 500 return periods. Now those correspond to actual probabilities. So 1 in 100 is a 1% probability, a 1 in 250 is a 0.4% probability, and 1 in 500 is a 0.2% probability. So other stress tests we look at are reserve stress tests. This could be for insurers with typically high reserve leverage. So this could be applicable to MPLI writers.
Great.
Also, we look and we stress test market risk. So scenarios could include a stock market decline like in 2008, or perhaps a 3% interest rate rise that was experienced back in 1994.
Okay, perfect. Thank you. All right, so 2 other questions came in. I know we addressed one. The other one, how long does the process take? I know Andrew addressed that, right, 6 to 8 weeks. Let me just take a quick look. No, okay, we are good. I think that concludes our presentation. I think we covered all the questions. Please, if you have any questions, just reach out to any one of us. Thanks so much for your attention today. We hope you found all the information helpful, and have a wonderful day.